Hey everybody, it's McElroy here. So I'm predicting there's going to be a massive housing crash at the end of 2021. And if you want to hear all the details, please be sure to listen to the very end, because I'm going to go through the different reasons as to why I think, and they're facts, they're not opinions. So let's first talk about why housing is strong and why housing is weak. So you always need to go back to the two fundamentals, which are supply and demand. You always have to move to that. So as everybody talks about real estate on a national scale, or real estate on a state scale, or even real estate on a city scale, we all know that real estate performs differently in some areas than it does in others. So the key to finding out where to be, as Wayne Gretzky says, you want to skate to the puck, not where the puck is. You want to find out where things are heading, and there are lots of information on the internet for you guys to predict this stuff and kind of make good decisions moving forward. So I want you to look at the data, the raw data, and I know it's confusing, and I know there's lots of opinions out there, including mine, but I want you to always go back to the data, and that's what I studied before this video so that I could deliver what I found so far just for you. So what I'm going to do is I'm going to summarize it for you in some show notes. All you got to do is click at the bottom of the video and you can have those for free. So one of the keys is to figure out, why does real estate sell quickly and why do prices go up in certain markets, certain submarkets, certain cities, certain states, certain countries? All of those things, and there's lots of factors, but I'm going to talk about three. The first one has to do with inventory. Low inventory, higher prices. Just like anything, when there's more demand for something, inventory is typically low. So think about the way that this pandemic has driven prices up for food, as an example. So we all know that the toilet paper was out and the hand sanitizer was out, and you started seeing bottles of hand sanitizer on the internet for sale for a lot of money. The reason was not because hand sanitizer changed, it was because there was a high demand, low supply. So right now, when inventory is low, and it is, and I'm going to talk about that in a minute, that's one of the factors that's going to keep sales high and prices high when inventory is low. The second thing are low interest rates. And we know these are historically low interest rates, and I don't believe, and most people don't believe, that interest rates are going up anytime soon. And while that's not necessarily a factor now, it's something to watch. Because if interest rates go up for any reason, it's going to have a further negative impact on the prices and on the sales of real estate. So what happens is when the Federal Reserve lowers interest rate, it puts more wind in the sails for real estate. It pushes the sales and the prices and all those things further. That's exactly what happened in the single-family market. That's exactly what happened in the multifamily market. And so that was kind of the last piece of the tailwind. So before this pandemic, everybody was wondering, when is all this going to crash? It just happened to crash due to this pandemic. So the third one, of course, is just basic income stability. There's a lot of people in a lot of pain right now. There's a lot of uncertainty, a lot of anxiety, and a lot of stress. If you're a business owner, there's a lot of stress about whether you're going to reopen, about whether or not you're going to have the customers that you had before, and what is going to be considered the new normal. If you're an employee, you might be wondering if your employer is even going to open back up. If you're an employee, you're wondering whether or not you're going to have the employment benefits, that we have at the moment to be able to help people pay their things like food and rent and those kinds of things. So there's a lot of uncertainty. So I would say that at the moment, we do not have income stability right now. So now let's take a look at the factors that create a reduction in real estate sales and prices and momentum. Number one, inventory. High inventory. Of course it does. Higher inventory, lower demand, lower prices. Okay? Just the opposite of what we just talked about. The second one, of course, is interest rates. I don't think interest rates can go much lower. They're incredibly low right now. So that's why the government is using all these other things to try to stimulate the economy, because interest rates are already very, very, very low. So I don't expect those to change much. The third one is, again, income stability. So for this video, I'm going to focus on two things. One, the income stability, and two, the inventory. And then I'll conclude it at the end for you. So if you guys like this, please like or subscribe this video and to my channel, because I like to tie this back to the community if you think other people would like to hear this message. So thank you. So let's start with the first one, income. Let's look at the facts of where we are right now. And what I want you to do is, I want you to go to the website, www.epi.org. And this is the Economic Policy Institute. Now, the reason I like this website, you're going to take a look at real data, and they have analysts and economists to dig into this data around unemployment, the CARES Act, and all of these things. And they're trying to predict forward, of course, where we are on unemployment and the fallout that we're going to have on the furloughed employees, the employees that are getting benefits, et cetera, et cetera, et cetera. So I'm going to summarize their information here for you. So I'm sure a lot of you have read all about the unemployment statistics, okay? So we know that there's been at least 44 million people that have filed for unemployment, and a lot of those people have gone back to work as the different states and cities have opened and reopened, et cetera, et cetera, et cetera, okay? But as of right now, what we do know is this. There are 21 million Americans right now getting unemployment benefits. We definitely know that. And one of the things that I want you to look at with the Economic Policy Institute here is nearly 11% of the workforce is out of work with no reasonable chance of getting back to a prior job, okay? So as you start to dig into these statistics, here's what you'll find. 4.9 million employees are currently furloughed or still in the employed category that will not go back to work per the Economic Policy Institute. Now, is it possible that they're wrong? Yes. Is it possible that you're right? Yes. I don't really care. The point is that somebody's right. And there's going to be a lot of employees that will not go back to work that are currently employed and are currently furloughed. The second big piece, as you'll find from this data, is 6.6 million people have dropped out of the workforce. So let's do some simple math. You got 21 million people that are currently on some kind of financial benefit, some kind of employment benefit from the government. You got 4.9 million people that the Economic Policy Institute are saying are not going to come back to work. And you have 6.6 million people that have dropped out. So as you add all those up, that's 32 million people. They also go on to predict all kinds of other things, like 30% of the businesses will not survive and will not come back to work. Therefore, that's going to be even a bigger number. But we do know that a large part of those 21 million people will go back to work. So the question is going to be, of the 21 million people that are currently on unemployment benefits, how many of those people are going to go back to work? So based on the information from the Economic Policy Institute, I believe that it's going to be somewhere around 70%. So 70% of the 21 million people will hopefully go back to work. Why is this important? When the economy reopens and businesses go back to normal and people go back to their work, we are going to have some kind of unemployment. The question is, how many people? So my estimate, based on the information as of today, when the dust settles, we're going to have somewhere around 23 million people unemployed. And if you know, back in my prior videos, I suggested that we were going to be somewhere in the 18 to 20 million people unemployed, and I got lots of hate mail from it. So thank you guys, keep that coming. Of course, this is just data on the internet. You can dispute it all you want. So let's settle in on somewhere around the low 20 million of unemployed, because it's going to be a big number, guys. It's going to be. Here's what I want you to realize. And back to the income stability. This is going to force people who are having problems paying their rent, paying their mortgages, paying their landlords. It's going to force people to close their businesses. It's going to force people to go on unemployment for a long period of time when they don't want to. It's going to force people to take pay cuts. All of those things are going to happen. And most importantly, millions and millions and millions of people are going to cut their spending dramatically, and they're going to stop purchasing, and they're going to stop buying things like real estate. So we all know that people have been massively disruptive and incomes are in question. So let's just talk a minute about the CARES Act. So as we know, the CARES Act has multiple things in it, but I'm going to talk about three things. I'm going to talk about the PPP, which is the Payroll Protection Program. I'm going to talk about unemployment benefits, which is the $600 more a week that everyone's getting. And I'm going to talk about forbearance. Those are the three things. And here's what we know. We know that 30% of Americans missed their housing payments in the month of June. That's a massive, massive number. This is what we know already. Again, it's just data, but we know that it's a combination of rent and mortgage. So the PPP program is obviously directed at business. So let's just hang out over here for a minute. The PPP program was rolled out in March, and some got their money in April, but essentially it was to pay for employees that were furloughed or to keep the employers to keep their employees. That's what that was for. That is ending. Then we have the unemployment benefits, which we know were an additional $600 a week. That is scheduled to end at the end of July. And we know the forbearance program that started in March, a lot of people jumped on that. And we know that at least 4.5 to 5 million people have elected to use the forbearance program, which we'll get into later. So you guys can jump all over the internet and take a look at the number of people, the millions of people utilizing the forbearance program and the amount of people struggling right now to pay their rent. Recently in the New York Times, there was an article about renters facing eviction, and they estimated that somewhere between 19 and 22 million people are facing eviction between now and the end of September of this year. So you have this forbearance program and you have this eviction issue going on, all as a result of income stability or no income stability, all of it. And it's all being propped up by things like the PPP and the unemployment benefits and, of course, the forbearance program, among others. So I think we can all agree that income stability is clearly going to be a future issue. And right now, a lot of people are propped up with these government stimulus programs, and there's a lot of uncertainty and stress and anxiety around all these programs right now. And I think we can agree that we're going to have a lot of unemployment at some point when the economy reopens, because there's a lot of businesses that are not going to survive. So let's move to supply. So we're talking about inventory. So we all know that high inventory drives prices down and low inventory drives prices up. So I've been asking a lot of my real estate professionals, why is it that some markets are on fire? And why is it that sales are brisk? Why is it there are price wars right now going on in the first few months of this pandemic? It just doesn't make sense to me. So here's the reason why. If you Google Zillow and the number of listings, you'll see a 28% decline in the number of listings. Now, there's some states that were fine and there's other states that were not. For example, New York City declined by 57%. Imagine that. Over 50% of the listings in New York City were taken off the listing service. So what does that do to supply? It lowers the supply. It lowers the inventory of things that people can buy. So this is the point of why prices are going up right now. People are largely moving out of bigger cities like Seattle, New York, Los Angeles, Chicago. And they're moving out to these suburbs because there's more open space, there's not as dense, the prices are less, the property taxes are often less, the rent is often less, the mortgages are often less because the home prices are less, the cost of living is less, and they can work remotely. So a lot of these smaller little submarkets are actually doing pretty well right now. But nobody's really calculating in right now the 4.5 to 5 million people that are on forbearance and the 20 million people that are facing eviction by the end of September. Those are two massive factors. And what you're going to see are people moving out of apartments and people moving out of homes that can't afford them for all kinds of reasons. So this is how forbearance works. You get up to 180 days to defer your mortgage payment. And then at the end of that, you have to prove hardship you can do another 180 days. So I predict that in September of this year, late September, unless the CARES Act is extended, you're going to start to see these mortgage foreclosures pile up. You're going to see a little bit at the end of 2020, but really it takes a while for people to walk away from their homes. It's going to spill into 2021. And the ones that can prove hardship and get another 180 days, well, then that expires basically in March or April of 2021. So this is why I believe, because of an inventory issue, we're going to have a lot of renters displaced and we're going to have a lot of homeowners displaced in the millions and millions of homes. So we're going to have two waves of inventory. We're going to have an inventory wave at the end of the year, and we're going to have another big inventory wave at the end of next year. I also predict that there'll be even more foreclosures. And what's going to happen is these homes are going to go back to the banks, or the people are going to try to list them to scoop whatever equity they might have so that they have that cash to be able to survive based on potentially not having any income. So that's going to put further pressure on the amount of homes and the inventory on the listings, which again increases the inventory, lowers the prices. And just like in 2008, the inventory will be in the millions of bank-owned homes at the end of next year. Now, there's a few things that can totally kick this can down the road. And that, of course, is the extension of the CARES Act. So we still don't know whether or not the $600 per week for all those who are unemployed is going to stay or not, or be extended or not. We don't know whether the forbearance program will be extended or not. We don't know if jobs are going to return or not. We don't know whether businesses are going to get their PPP or not. We don't know if the businesses are going to survive or not. So there's a tremendous amount of uncertainty, but this is where we are now. What I'd really like to do is talk to you about a few things that you can watch, things that I watch, in order to stay ahead of all these things that are changing on a daily basis. So I do believe that this is what's going to happen. We're going to have income instability, and we're going to have high inventory at the end of next year. So here's a couple things that you can do right now. One, first, wrap your head around the fact that prices will drop, because I know a lot of you are going to argue with me and ride it all the way to the bottom, and as I like to say, catch a falling knife, or continue to hold on to that falling knife, or buy a falling knife. Two, know that inventory, price drops, rent drops, etc., are going to be submarket to submarket. This is not a national thing. It's not a state thing. It's not a city's thing. As you guys know, I live in Phoenix. There are some areas of Phoenix that are great, other areas of Phoenix that are not great. Some areas are going to be more impacted than other areas. So when you say Phoenix, it doesn't necessarily mean the entire city. Be careful of the big cities right now. People are moving out of Seattle. They're moving out of LA. They're moving out of New York. It's not time to buy yet. Monitor new listings and sales on Zillow. Make sure you guys are connected to large companies that monitor the real estate industry like Zillow or Realtor.com and those kinds of things. And then you can now see where listings are happening and prices are increasing or reducing. You can see all that real time. It's a true survey of what's happening in the market as people add listings. Pay attention to supply and foreclosures and inventory. You're going to see high inventory in some areas and low inventory in others. Just be very, very cognizant. You can still make money. You can still invest in this kind of a market. Trust me. But you need to be careful and need to monitor these things at a much more organic, granular level. And lastly, pay attention to population migration patterns. And what that means is, where are people going? It's very important you understand where people are going, because you want to be there. You want to be in front of that. You don't want to be at a spot where they're leaving from. And there's a great website that I pulled up for you. And this is the US Census Bureau. And it talks about migration patterns and where people are going right here, recent migration flows. It's all on the internet, folks. There are lots of ways to look at this. You can look at out-of-state driver's licenses that are being turned into cities and states, so you know how many people are moving to Idaho, for example, because when they get here in 30 days, they have to turn in their driver's license. There's services like North American Van Lines that produces, like, where are the moving trucks going, or U-Haul, where are the moving trucks going, where are people renting Ryder trucks and U-Haul trucks, and where are they going and where are they being dropped off, because it shows if they're moving from Seattle to Phoenix. It shows, it's data. All that's on the internet. You can find this stuff. You need to really be careful and take a look at the outflows versus the inflows, because you do not want to be buying something that has an outflow right now. And lastly, I want you to be cognizant of one more thing. I'm going to predict that property taxes are going to go up dramatically in most areas. Here's why. The government can't throw all this money at the economy and not get it some way. And what's going to happen is property taxes are going to go up in most metro markets. And I do understand that property taxes pay for things. I get that. But if you're an investor or you're a property owner, it's going to affect you because you're actually the one paying it. So be cognizant on the government's stance around property taxes and any other kinds of taxes. Because I can tell you, people right now that are hurting, that don't have money, are looking at those things. They're taking a look at where they could live the most efficient with what they have today. So thanks for listening.